y'all know, my name is Trip Watson. I'm with the Watson firm, the Entrepreneurs Law Firm. And when you're starting a business, it's very critical to make sure that you have the absolute best talent possible. In order to retain the best talent possible, you have to be able to give them benefits that include retirement plans, disability plans, whatnot, that some of the perks end up being more important than the salary itself for a lot of the people that work for you. So in order to keep and maintain that workforce, you have to be able to have the benefits that are good for it. So today we're going to have Scott Sutton talk to us today about retirement plans, what pros and cons go into that as far as a business owner standpoint, just kind of give you all a little bit of an idea of what they do and how that marketplace looks. So
right.
Scott?
Thank you very much. And I always say that every business needs a retirement plan. However big or however small, there's always a retirement plan for each business. You know, you can work with 401ks or simple IRAs or individual IRAs. But today we're going to concentrate on retirement plans that help maximize small business owners who actually have pretty big cash flow. These types of arrangements are for businesses, owners that either have windfall tax for a couple of years or every year. So it's a way to maximize and get above the normal 401k limits that you might have in just regular retirement plans for small businesses. So there's a couple, there we go. So the three that we're going to concentrate on today: solo 401k, profit sharing plans, and cash balance plans. There are other plans in order to, you don't achieve the same capabilities, but there are ways to maximize plans. A non-qualified plan, I'll briefly touch on this. A non-qualified plan is an after-tax plan. 401ks, pre-tax, non-qualified after-tax. There are no funding limits on a non-qualified plan. Most of these are set up for businesses where an executive is maxing out his 401k and wants to put additional money away for retirement. These are discriminatory in nature, only offered to executives, owners, officials of the company. They can put as much money as they want in a non-qualified plan, but again, after tax. You do not pay, you pay taxes on the earnings at distribution. So you're able to earn income in these plans, deferred tax, and then when you take the money out, you pay taxes on the income from the plans, but not on the contributions. And believe it or not, defined benefit plans still have a role in small businesses. There are ways that you set up a defined benefit plan, you can get high funding levels for those. They're complicated. You can actually, a fully insured defined benefit is one that you use whole life insurance for. We're not going to talk about those, but I always like to put a bug in the ear that there are roles for defined benefit plans in today's marketplace for small businesses. First one, solo 401k. Everybody knows what a 401k is. A solo 401k is the same type of arrangement except for a business owner where it's just a single employee company. Business owner, he's the only employee and he might have his spouse work for him as well. So if you have employees, this is not a good arrangement for you. The deferral limits that we set up, these are the regular 401k deferral levels. $17,000 for an individual plus $5,500 catch up for somebody over 50. So if you're over 50, you can defer $22,500 of your income into a 401k. That's a lot of money. I mean, it's a lot of money for anybody. The maximum, I want to jump down, the maximum of any 401k is $50,000. So let's say you're at a large company, you put in, you're 55 years old, you put in $22,500, the company could match you up to $27,500 for a total of $50,000. Regular 401k, that's the maximum you get in, $50,000. Same thing with the solo 401k, but there's two components for a solo 401k. There's your deferral piece plus 20% of self-employment income. Self-employment income being defined as your net income less 1/2 your self-employment taxes. So self-employment taxes are about 13.3% now. I believe that's right after the deduction. I think they'll go back up to 15.3 at the end of this year with the 2%. So, two pieces. Your deferral, employee deferral, which is up to $22,500, and then your employer contribution. So let's go through an example here. We have a 55-year-old business owner. He's got net self-employment income of $100,000. His total contribution into a retirement plan can be $41,110. That's the E contribution of $22,500 plus your employer contribution of $18,670. That's 20% of $100,000 less your self-employment tax of about $6,300, I believe. I don't have that math right in front of me. So look, $41,000. I mean, that's a lot of money. I mean, that's a lot of money to put away for a retirement plan. Now, comparison. Simple IRA. You hear a lot about simple IRAs. Simple IRAs are group employee plans. The contribution level for a simple IRA is, for him, it would be $17,000. And this is, he can defer $14,000 of his own money plus 3% of his income. So with the simple IRA, he sets up a simple IRA, he can only defer $17,000. With a SEP IRA, a Simplified Employee Pension Program, called a SEP IRA, it's 25% of his self-employment income. So he can only put in the $100,000 less half his self-employment tax times 25%. So you can see the benefits of the solo 401k setting this up. Now, profit sharing plan. Everybody thinks of a profit sharing plan pretty simply. You've got people, compensation, you allocate a certain amount of money that the company puts up to those individuals based on their compensation. One person, you've got one person makes $50,000, another person makes $50,000, you split it down the middle. One person makes $75,000, one person makes $25,000, the individual gets 75% of the contribution, the other person gets 25%. There's a couple of ways to do these where it effectively pushes more money to owners, executives, and people with higher incomes. Now, you still want to be fair, and you're still giving money to everybody at the company, but you're trying to maximize your contribution to your owners and executives. Now, with a 401k, you usually couple it with profit sharing, you usually couple it with a 401k, but you can do it as a standalone basis. And also, you have to have this in a document too. So if you have a 401k document, you have to make sure it allows for profit sharing, and it specifically tells how the profit sharing will be done. Now, two examples I'm going to go through quickly are, first one, tiered profit sharing, meaning you create different levels within your company based on, you can do it on age, tenure. The new comparability method is a particular way to do it on compensation. So you will have different tiers within an organization. A great way to, ideal client is a law firm. They say with less than 50 employees, you can do it more, but in order to maximize. So you would have a tier for the owners or the shareholders in the corporation or the LLC. Then you'd have a tier for managers, and then you'd have a tier for staff. So that within those tiers, you will allocate more money to the higher tiers than you would the lower tiers based on compensation levels. So like your profit sharing, I believe you can, that's on the next. You can, I don't have an example with this one, but just know you can separate this into tiers. These calculations get a little bit intricate, and I couldn't put it on a good slide, or at least a slide that you guys wouldn't fall asleep with. So tiered allocations, you could push more money to the higher people in the firm, owners, shareholders, and then still allocate some to the individuals in the lower tiers. Second type is an integrated profit sharing plan. So these are a little bit complicated, so I'll go through this pretty quickly. Integrated meaning that you create a disparity. You create a disparity where you're going to allow higher income, higher distribution levels for the people with higher compensations. And usually you do these, it's based on, in most cases, based on people above the Social Security income base, which is $110,100. The Social Security system uses its income base to identify key employees in a 401k. This is the maximum limit for Social Security benefits. So if you make over $110,000, you pay Social Security up to $110,100. So disparity, meaning you're able to create higher percentages, higher allocations to the people with higher incomes, compensations above this amount. Maximum disparity, 5.7%, limited to 2 times the profit sharing percentage. You guys got that? Got that piece? We'll go to the next one. Mary makes $150,000, John makes $100,000. I apologize for the discrepancy. And they have a profit sharing plan where they're each going to get 10% of their income. Now Mary makes $150,000, so she's going to get more. Normally 10%, $150,000, $15,000. 10% of $100,000, $10,000. So if you have an integrated profit sharing plan, John is going to get the $10,000. That's 10% of $100,000. Mary, instead of $15,000, you're actually going to bump her up to $17,274. Now, because she's going to get 10% up to her Social Security income base of $100,000, then she's going to her disparity, 5.7%. That's the maximum. So you add the 5.7% to the 10% and get 15.7% of any income above the Social Security base. So you're able to, again, maximize her contribution because of that disparity. Now, this is an example where they're really close. A lot of times you'll have, where it works effectively is if you have several high-income individuals, making $150,000, $200,000, and then a staff where they're not making $100,000, making $30,000, $40,000, and you can create a higher disparity. Again, you're still trying to be fair to those staff members because you are giving them profit sharing. You want to give them as much as you can afford, but you are able to push additional levels up to the executive management as part of their compensation plan. So 2 types of profit sharing, integrated and the tiered, that would be able to enhance those benefits for the executives above and beyond a normal profit sharing plan. Okay, one more big one. You guys still hanging in there? Cash balance plan. Has anybody ever heard of a cash balance plan? It's a type of defined benefit plan where you have all your investments in one big pool. So each individual person does not manage their separate investments. An advisor will take all the money in that cash balance plan and put it in investments. It'll grow, have growth or loss depending on the market, depending on what investments they have. But each person within that plan has a piece of that. They have a percentage based on either tenure, compensation, any other factors that the company would like to put forth. Now, the advantages of a defined benefit plan: large contributions allowed. There are limits, but they're basically they'd be limited by the income of the largest, or limited by the income of the participants in the plan. Benefits, fixed and guaranteed. So you're creating, again, a defined benefit plan. So you're taking this money, giving the allocation to individuals, and it's, again, based on tenure and service. So you will have a guaranteed benefit for your employees. I mean, you're creating a type of defined benefit plan where they have a piece, kind of like a pension piece, of this of the cash benefit funding. And contributions are tax deductible. This is a big one. This is a big one for the owner of the company, that they're tax deductible, because you create the savings from a cash balance plan in order to fund contributions to your employees. Disadvantages: contributions are mandatory. Just like a defined benefit plan, if you have a cash balance plan in force, you have to make a contribution in order to meet certain funding limits. You can freeze the plan. You can freeze it so that for that year or 2 years, you don't have to make those contributions. But if your plan is active, you must make contributions. Pension benefit guarantee insurance might be required. Certain companies, I don't remember the limit. I believe it's 25 employees or more. But this is a big expense. I mean, this is an expense that, again, might be warranted, but it is something to consider when you're setting a plan. You'll also have higher admin expenses than a 401k or a regular profit sharing plan because you have valuation and the complexity of the computations for the distributions. Ideal candidate, small professional organizations, doctors, dentists, law firms. And the individual, the owner, is closer to retirement. Older owner, younger workforce. Older owner who makes a whole lot of money, younger workforce, well paid, but doesn't approach the income levels of the owner. The reason is it creates more money going to the owner. If he's older, he's closer to retirement. So again, benefits are guaranteed. So they're setting up a defined benefit plan for this individual closer to retirement. You have to fund more. So the older you are, the higher the funding will be. And again, I mentioned this before. Entities with strong cash flows. These are plans for individuals, for companies that are making a good bit of money. Okay, so our example: we have a doctor's office, one owner, 3 staff employees. They have a cash balance plan, but it's coupled with a 401k. Again, this is an extreme example, but a good one to put in. So let's say we got the doctor. The doctor, he makes $500,000. Employees, anywhere from $60,000 to $40,000. Now the doctor puts away his $22,500 in to the 401k. The employees, they might put some money in. In this example, they don't, because it's not part of our calculation in sort of enhancing what we're trying to show. But they could. The doctor does pretty well. And through the 401k, he puts in a safe harbor match for himself as well as the employees. Now, the safe harbor can be done several different ways. We're not going to go into the calculation here. And I'll say this calculation is based on an example I had from our administrator, so I did not do the full numbers for these. But you can see he puts in some, and he is matching his employees, anywhere from $5,000, depending on age. We might not know the age of an employee too, and their compensation. And then in the cash balance plan, the formula, because of the doctor's age, because of his compensation level, he puts in almost $200,000, $207,000, $208,000. He's going to get $205,000 of that. Again, this is specific to this case. It's not like an allocation percentage. It depends on the compensation, his age, the age of these 3 employees, which were not in the example, but we can get the idea. All these 3 are young, doctor's old. He's able to very heavily weight what his contribution is. So he is able to put in $235,000 for him for retirement. In addition, he has put in, almost $15,000 for an employee, $14,982 for his employee. So $250,000 into his cash balance and 401k plan, but he's maximizing this by putting the most in for him. I mean, he's done great for his employees. I mean, that's a great, great benefit for his employees. But again, he's able to maximize his contribution as well. I mean, he does want to make sure he does that. And the best part of this, all these contributions are tax deductible. So he is going to get $80,000 tax savings by putting in this plan. So he has more than covered his expenses for his employee and just socked a whole lot of money away for him for retirement. Now, again, it's an extreme example, and again, it's not for everybody. You know, these are for organizations. And again, this is a particular example of how the calculation could be. If you had 6 employees, it'd be different. If the doctor was 40, it's going to be a whole lot different than he is if he's 55. But it's still a good way to max. I mean, remember, 401k match, or 401k employer contribution maximum is $50,000, and he is able to put $235,000. That's just you know, that's getting the most out of your money. One thing I was going to say, these are all pre-tax, so you know the government is going to take their tax. So if you're pre-tax, the doctor will pay tax on the $235,000 when he takes a distribution after he retires. After 59 and a half, he can take a distribution. And so he will pay taxes on it. Tax savings now, these tax rates are on the maybe 35% level. The benefit coming as he retires, his tax level will go down, tax percentage will go down, so he's going to save tax. I mean, this is tax savings, tax deferral. He will have to pay tax on it eventually, and so will the employees. So again, extreme example. My thought, what I want to make sure we talk about is that there are ways for owners, executives to maximize their 401k contributions above and beyond the 401k limits. Again, for those companies that have large cash flows and are able to put that money away and can cover their expenses. The one thing I want to mention, you know, we all want that problem. Too much money. You know, we don't get it very often, but you know, this is a good solution for these companies and a good solutions for accountants, employee benefit lawyers, anybody that might be in contact with companies, small business companies that have this situation. So thank you very much. Appreciate you guys coming. Are there any questions? I know that's a lot, so you just digest. You know, the main thought here, and I always say it, there's a plan for everybody, and it's not just a one-time solution, whether it's 401k. There's got to be, you've got to evaluate the situation, evaluate the owners, evaluate the company, and where the company is going to do some forecasts to find the right plan for them.
All right, guys. Scott Sutton of Business Planning Incorporated. I've included one of his cards in y'all's packet if y'all would like to look at his website. It's also businessplanninginc.com. Thanks again to Scott. Lots of good information. I appreciate it.
Thank you, Trip. You can tell, you know, retirement plans all get you excited, doesn't it? Just kidding.